especially we under this COVID-19 situation. Like in this hall, you can see we have invited Japan, Korea, Cambodia, all the countries to have a showcase. And this showed our determination for continuous opening up. For the opening up of or establishment of Beijing Stock Exchange, it is a new measure to provide a platform to introduce or redirect more capital for small and medium-sized companies to incentivize innovation and creative trading.
Yeah, so I think it definitely displays the confidence China have in further opening and reform to outside world. And that will definitely instill confidence for business, and especially international business, to come to China to enjoy this opening. We are especially excited about the announcement of establishment of Beijing Security Exchange. That will provide another layer of capital market, especially encouraging innovation and entrepreneurship, which are the core for our digital transformation.
Well, foreign invested financial institutions are playing an increasingly big role in China's securities markets, taking advantage of Chinese government policies opening the domestic financial sector to foreign firms. At the same time, they're providing more opportunities to local investors as well. Zhang Shixuan has more.
Having been doing business in China for 14 years, Fullerton became the first Singapore-based asset management company to be granted the RMB Qualified Foreign Institutional Investor status and approved for dealing on the China interbank bond market in 2014. With its wholly foreign-owned entity in Shanghai, the company launched its first equity private fund in China in 2018. Since then, it has been offering services to not just overseas clients, but also to domestic investors. And it's been good business. Its investments have seen an annualized return rate of 14.6%, and the company is looking forward to more.
The
A-share market is behaving quite reasonably, and as the Chinese economy continues to grow, listed companies have high-quality assets with large profit capabilities and potentials. And since the outbreak, China's overall monetary policy has remained relatively loose, so we're optimistic about the mainland stock market and the bond market as well.
The growing market is showing it's attractive to plenty of newcomers as well. JP Morgan has just announced that the regulator has given it the green light to take complete ownership of JP Morgan Securities China from its 4 Chinese shareholders, making it the first foreign firm to fully own a securities venture here. The company says that China represents one of the largest opportunities in the world for many of its clients and for itself, and it will also help Chinese companies grow internationally. These developments not only highlight the enthusiasm for foreign financial institutions for operating in China, but also reflect Chinese regulators' resolve to advance financial liberalization. In recent years, more than 100 foreign invested banks and insurance, securities, payment, and clearing institutions have been approved and set up here. They've been actively expanding the scope of financial businesses, especially since the Chinese government scrapped foreign ownership limits on securities firms and mutual funds last year.
We help companies with their business registration, location choices, and recruitment. We are working on spreading information about our policies so as to let overseas firms better understand us and strengthen their confidence in operating here.
Experts say the arrival of the foreign invested financial institutions will bring more diversified financial derivative products and businesses to the mainland market, accelerating its upgrading and internationalization, but at the same time potentially putting pressure on domestic firms.
Domestic firms are good at serving local firms, raising money domestically. In terms of business transactions, due to their lack of retail channels and their lower commissions, overseas firms will probably avoid competing with local firms in traditional retail business transactions and credit trading. But they will present great challenges to local firms in serving high-end or high-net-worth clients.
In the first half of this year, overseas investors increased their holdings of yuan-denominated bond by over 450 billion yuan, up 40% year-on-year. And a State Council executive meeting in July announced that China's financial liberalization will continue. Regulations on cross-border transactions between parent and subsidiary firms will be improved, and there are to be more ways opened for foreign capital to participate in domestic financial markets. 张世璇, ICS for CGTN, Shanghai.
And today is day 2 of the China International Fair for Trading Services. Now, for more details, let's cross over to my colleague Zhu, who is in one of the venues of the fair, that's the National Convention Center. And tell us, Zhu, what are the key highlights from today's visit?
Thanks, Lily. So today I've visited the special pavilion for digital services trade of the International Fair for Trading Services. It's really amazing here that it covers an area of over 11,000 square meters. And many well-known companies such as Alibaba, Huawei, and also Deloitte all participated to showcase their products. And some of the amazing VR products that really impressed me. For example, the Imperial Palace Museum launched its VR version of its Imperial Palace that can take you to visit the whole palace and every detail of the palace, even including those palaces that are not able to open to the public due to their cultural relic protection reasons. And also, another VR product that really impressed me was under Qianxing, who's also one of the sponsors of the International Winter Olympic Games that will be held in Beijing next year. It is a skiing machine, and I would just literally step on the skiing board to experience how it feels to ski in those high-altitude mountainous area. That's really just breathtaking for me as a skiing novice to try those innovative and very interesting experiences. And some other products, including those that can help save us time and also reduce those labor-intensive procedures. For example, the financial robots under Deloitte and also the driverless cars under Baidu. Those products can help us save time and improve our working efficiency. So I'm very looking forward to see how those amazing digital services products can help us have a better future. So that's all. Back to you, Lily.
It all sounded very exciting, very interesting, and I hope you enjoy the fair. Thank you very much. That's my colleague Zhu at the ground of the China International Fair for Trading Services. Well, recently, government regulations in China on sectors like technology and education have sent some Chinese shares tumbling, and that has caused investor jitters. And Robin Xin, chief economist of Morgan Stanley, said that those measures are an indication of China's shifting from growth first to a more balanced approach between development and sustainability.
Well, dear Robin, thank you very much for accepting CGTN's interview. Recently, the Chinese government tightened the regulation in many areas, like the tech area, education industry, personal data protection. It has a huge impact on the stock market and even the real economy. What kind of signals do you think the government is sending out?
I think the signal is we are at a significant moment in the history of China's economy and the capital market. What is behind the regulatory reset is China's new objectives in this new era to balance growth and sustainability. That is an agenda addressing social equality, environmental sustainability, and data safety. So under this framework and the reorientation of policy priorities, we have therefore seen these intensifying regulations across sectors, as you just mentioned, including fintech, big tech, after-school tutoring, and the carbon emissions. Each of them is about addressing a certain issue, like the over-concentration of market power, the eroding of welfare in SMEs and public labor force, and curbing the regulatory arbitrage and the financial stability, and finally to reduce data security risks. But if you connect the dots, they underpin a major governance priority reset. That is a shift from growth first to balancing growth and sustainability. That's the signal.
China recently proposed a policy guideline that is to promote common prosperity. What does this mean to individuals and business?
Well, broadly speaking, we believe that policymakers' goal of common prosperity focus on the challenges of rising income inequality. But the economic development has now reached a critical juncture. Per capita income is on the journey to crossing the high income threshold. But the distribution of household incomes has become markedly uneven. The most pressing need today is to address income inequality and raise the share of wages in GDP to support the long-standing goal of rebalancing the economy towards consumption. So with a wage share of only 50% of GDP and the relatively high levels of precautionary saving, given the limited access to healthcare, education, and housing, especially for, say, migrant workers, the proportion of private consumption in GDP is naturally limited. And raising the share of household incomes in GDP and reducing inequality while tackling the three big mountains, like escalating healthcare, education, and housing costs, should support a higher share of private consumption. So that is what the common prosperity is about, rebalancing the economy in favor of labor, in favor of consumption.
Which sectors do you think may benefit from this policy, and which sectors may suffer?
We believe that policymakers understand the challenges posed by dampening corporate sentiment and investment, and they will try to steer a middle course between tapering the worst effects of market forces while ensuring a reasonable and sustainable rate of economic growth. So over time, what does that mean for sectors, for business? We see regulatory headwinds for sectors associated with rising tensions of social inequality, environmental sustainability, and data security risks. That may lead to some systemic de-rating, say, in the business model or valuations for certain sectors. But this new framework, as we mentioned, if the policymakers were trying to strike a balance, this new framework also provides policy support to sectors such as advanced manufacturing, tech localization, and clean energy. And that means for business